All right, everybody. So big changes that you need to know about have just occurred within the real estate regulatory framework for lending. What this essentially means is that the government of Canada has made it a ton more affordable, but also made it easier for people to completely blow their brains out with debt. In my opinion, this is a really good thing for the market in the short term for people who are having trouble selling, but it's going to be probably terrible in the long term because we're just creating a lot more unstable debt in the future moving forward. But alas, I am not a mortgage expert. And so I did call in two mortgage experts to talk about this separately and see if they were saying the same thing about their opinions on it and what we can expect and how this will affect the market. But quick, before we do, don't forget to subscribe to the channel by clicking the button below this video. And if you like this content, hit that like button so this content can be pushed out to more people like yourself. And if you're joining us on Spotify, Apple Podcasts, or anywhere else you enjoy podcasts, please leave a review so that this content can be pushed out to more people. And if you have any questions and you'd like to chat with me about the market, feel free to click on the first link in the description below. That'll connect you to a calendar where you can book a time to chat with me at a time that is most convenient for you. Or feel free to just shoot me any question you have to adam@visionrealestate.ca, and I will send you a custom video response within 24 hours. All right, let's jump in. Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. All right, Jeff Mudrick, give us the scoop. Big changes today that are going to affect the real estate industry. We saw from the Canadian government on insured mortgages, which means buyers now all of a sudden woke up with a lot more purchasing power. Tell us how this actually breaks down when you look at the numbers. What does this mean for people?
Awesome. Yeah. What an amazing day it is today. Really what it does is just, like you said, increase, number one, the buying power for any first-time home buyer out there. And two, it's going to effectively reduce their monthly payments. There are caveats to everything. So with a reduced monthly payment, what does that mean? We're extending out the amortization from 25 years to 30 years. Amortization means the amount of time it takes to repay the mortgage. And from the past, I think 2012 onwards, the maximum amount of time we could extend our mortgage for is 25 years when we're putting less than 20% down. As of December 15th, the proposed change is that we get to extend it out to 30 years. So again, it does two things, like you mentioned. Number one, it's going to increase buying power by, depending on how much you make, somewhere around between $40,000 and $50,000 per household. Two, even though we're increasing that buying power by about 40-ish thousand bucks, your monthly payment's actually going to be lower than what it is today with $40,000 less of affordability. So it's exciting. There's pros and cons to everything, but I would say for most, it is a welcome change to see these amortizations being extended. And also, last thing they did is besides the amortization, we can now put less than 20% down for a purchase up to $1.5 million, where the ceiling, the cap was before was $1 million. So especially in markets like the GTA, it's a welcome change for buyers.
That was one thing that really caught my eye when I saw that they had changed the cap from $1 million to 1.5 million. Because I know that there are a lot of young professionals out there who have great income, but because of the cost of living in Toronto and the GTA, they simply have struggled to save up a down payment. Now, that ceiling that they've always been kind of kept under, the $1 million ceiling, has now been lifted. If somebody had a good income but didn't have the down payment necessary, how does this affect them, like in reality? Because there's, of course, the cap for insured mortgages, but then lenders would still kind of look at them and say, well, you're still asking to carry a higher debt load. We're not comfortable with that. Are lenders going to be okay trying to, push the envelope on this?
I would say more so than asking the question about the lenders. Anytime a mortgage is insured, who's it insured by? It's insured by three main insurers in Canada, the biggest being CMHC. So all of these rules and regulations, they're going to be sent to us from CMHC, not necessarily the lenders. The lender's perspective, do they really care? No, because if the client can't make their payments, that's why clients paid for this mortgage insurance. CMHC or Sagen or Canada Guarantee, these three insurers say, hey, don't worry, we'll pick up the tab if these clients can't pay. So really from a lender's perspective, yes, we're going to see policy changes for sure, but it's going to be CMHC that helps to guide those changes. To answer your other question, like what actual effects are we seeing, or what changes are we expected to see? Well, the cap of 1.5 million, the up by 500 grand is huge. So previously, if you went to buy a house, $1.5 million condo, townhouse, freehold, whatever that is, you would need to have $300,000 cash in your pocket plus closing costs to close on this property, to even put an offer,
Plus land transfer tax.
plus land transfer, plus everything. So in Toronto, I'll tell you what we were looking at. In Toronto, if you're buying a $1.5 million home, plus closing costs, plus down payment, we're looking at just shy of $350,000. It's a lot of money. I would say probably 80 to 90%, probably higher than that actually. The overwhelming majority of my clients who did not have a previous home and who are buying at that 1.5 or even anything over $1 million, majority of the time, clients are getting gifted funds from their parents or from whoever. Now, though, what the government says is as of December 15th, instead of needing $350,000 to close on the property, you need, we'll see, but this is based on today's guidelines, we would need $125,000 for the down payment, plus closing costs, still very expensive. But instead of 350, we would need 175. So literally like cutting it in half.
And lenders are just okay with this?
We will see. We will see. Again, it's the insurers because it's that still like the same loan to value as it would be under for the $1 million property. But
Right, but the total debt servicing ratio is higher, right? Because they're still going to have to carry higher costs for the insured part of the mortgage.
yeah, like I'm sure I'm sure that the premiums associated with taking a 30-year mortgage and purchasing over $1 million, the premiums are going to be higher than the premiums we see today. So right now, if you want the minimum down payment, we're paying 4% in addition as like the mortgage insurance premium. My guess is that 4% is probably going to be in the high 4s or 5% if you do want to extend to the 30 years and if you want to like buy over $1 million.
Wow. So this is definitely going to change the game.
I think it's I'm not the type of person to say buy now because yada yada yada, but a lot of clients are I think it's going to help the sellers in this market absolutely. There's I think so many buyers are buying right at that like 99999 mark. I know we've done a couple deals like that because they don't have 20% down. Now for sellers, hey, there's no excuse not to get that 1.05 or 1.1. It doesn't matter over the client's down payment because everyone's going to be in the same boat.
Right. And this also helps the bracket above as well, because if people can afford that entry level freehold property, let's say, that means that they can now move up, right? Because their buyers are now a little bit more empowered in terms of their purchasing power. So it's just gonna kind of trickle up. Is that kind of the sense?
I think so. Like I think absolutely. First-time home buyers, as we know, like they kind of help start to move the market. So if the government's incentivized to bring them really back into the market with things like this, it's going to get them in, which means those people who are selling their first or second or third properties, because then can then continue to like escalate their, build their real estate portfolio. The other really cool thing, I've just been running the numbers all morning, but so clients can now qualify for $40,000 more, set like, based on $150,000 of income and household income. Anyways, $40,000 more on December 15th than they can today. And even in doing so, their monthly mortgage payment is going to be $101 less than it is today for the same maximum qualifying amount. And that is because we're able to extend the amortization to 30 years and extend the amount of time, extend the amount of interest we're paying to the lenders, but it just offers us more flexibility.
Yeah, it just seems like Canadians in general don't really care so much about anything other than their monthly payments. And if that kind of, if that cookie crumbles in the right way for them, then the rest of it is all just semantics for the most part, which I mean, to me, doesn't seem like a healthy financial environment in general, but it seems like the government is really just trying to incentivize more like just consumers taking on more reckless amounts of debt. And I guess that concerns me. Is there anyone in your industry who has expressed concern over this?
If you go on Twitter or if you go on any like Facebook groups where this is brought up, there's a ton of concern. Absolutely. Like I think you're right in that monthly payment has monthly, this is not my opinion, but for many, monthly payment trumps interest. Like they want lowest month, a lot of clients want lowest monthly payment, not paying the least amount of interest. That seems to be the going trend. And then we do a lot of education around, hey, you can have the lowest monthly payment for now, but we're not spending an extra, we're not doubling the purchase price of this property because we're paying that much in interest. So, online in our forums and our chats, yeah, there's a lot of concern, essentially because of that, because of clients. Not everyone is financially savvy. And just because lenders say we can qualify for $40,000 more, it doesn't mean we should, nor is it a good financial decision, nor like maybe it doesn't turn our house into our greatest asset. There's a lot of debates about that. Um, I know we might have a different opinion, but the conversation around your primary residence being an asset versus a liability, I think this extension of amortization is going to boost the camp that say it's more of a liability than an asset.
Well, yeah. And for good reason, right? Like this is just increasing the debt burden and the ratios. I mean, it makes me concerned about CMHC, right? Which if all hell does break loose, which, you know, it, we can, people can say, well, yeah, it's doom and gloom YouTube kind of content, but I mean, how unlikely is it? Like we've seen a lot of turmoil. We've seen a lot of people in trouble. We've seen, you know, 2008 era type of tension being placed on the market, and we don't know how that's going to play out. And then just for the government to go and say, we think would be a good idea, let's increase debt burdens and let's encourage people to increase their debt load at higher interest rates. I mean, is that not ringing alarm bells for anybody else? I mean, it just seems a little crazy to me.
You know who it's helpful for? It's helpful for people who are going to probably buy a property in the next year, who are starting the process. It doesn't hurt. It hurt, depends, but it's exciting for those people because they're going to qualify for more and have a lower monthly payment option. It's just an option. You don't have to do it, but my whole, like what I talk to all clients about is in a mortgage, we want flexibility. The more flexibility, the better. And being able to qualify for more tomorrow or December 15th than we can today, I would say is a good thing for buyers. The other side of it is that it's also a very good thing for sellers, as we kind of chatted about. Like it's going to likely increase the cost of properties. I think that's a pretty safe bet to make. Um, Along with other things, the Bank of Canada is lowering like the overnight lending rate. That's all going to have an impact too. But I firmly believe this change is going to have a pretty significant impact on the market. And not super surprising that it's coming, in September of 2024, with a lot of talk around elections and early election. Like it's election season, and what happens when there's an election is stuff like gets done a lot quicker than it did.
Right. Interest rates come down, right? The NDP is distancing themselves from Trudeau, right? Pierre's trying to call for a vote of non-confidence. And surprise, surprise, all of a sudden we get a ton of relief on financing interest rates and more options for financing housing. I mean, yeah, that it doesn't take a, it doesn't take a genius to kind of see how that all interests converge, right?
Yeah, you got it. I'm curious to know your thoughts. What do you think? What kind of impact do you see this having on the market come,
I mean,
September?
I already saw in terms of the transactional side, which is where I am, I already saw activity picking up significantly right after Labor Day. We had seen that third interest rate, reduction in a row. That already on its own felt kind of like a starting pistol. And again, my perspective is completely anecdotal, so take it with a grain of salt. But business picked up significantly, and then all of a sudden, I'm talking to people and hearing the same thing from them that things are getting busier. Now, put that into the relativity of what busier is compared to what it's been over the last 2 years. Of course, it's not what we're used to. I think Torontonians in general need to be a little bit more realistic in what we view as a hot market or a normal market, because we're so used to something that is anomalous in terms of the raging FOMO that we had seen over the last couple of years. That we look at this market and we say it's softer. I mean, relatively speaking, yes, of course, compared to what it was. But when you look at the overall market, not only globally, but just across Canada, we're sitting at a consumption rate of somewhere in the vicinity of 3 months of inventory. I mean, that's still really low compared to any other place. If you were to look at any other city in North America, that's incredibly low, right? Meaning that we have a very healthy consumption rate. So things will still move if they're priced properly. Whereas in other cities, it's not uncommon to see, 5, 6, 7, 8, sometimes double digit months of inventory where consumption rates are really low and a market, where a property can sit for a year, 2 years, 3 years. For us, we have to really be able to step back and see things a little bit more, with an eagle eye perspective.
You
And
know what? Oh, go ahead.
yeah, and that's why I'm thinking, these changes with the amount of immigration that we've taken in over the last couple of years is going to spur a lot more activity. And we should be preparing for that. We should be expecting to see more activity, but it's not going to happen instantly. It's not like this is all going to move the market with the snap of a finger. It's going to take some time, but these are things that they more concern me than excite me because I do see the potential for backlash for something like this. Not now, but down the road, right? Higher debt loads are destabilizing to economies.
Yeah, I think these changes that were announced today and the decrease in overnight and the decrease in Bank of Canada has been kind of doing the last 4 months now and have told us likely going to continue into well into 2025. And I think sellers are going to come around to the idea that, hey, we're not getting that 5 to 7% appreciation that we thought we would when we purchased in 2018, 2019, 2020, 2021. And I think they'll be coming down in pricing. I don't know for sure, but the conversations I have, I get the privilege of speaking with a lot of people who are either selling their house or a lot of like real estate agents who are selling clients' houses who tell me oftentimes like similar things in that this client is like stuck on the price this amount and they're not going any less. And that's probably why things are holding for a little bit longer. But like you said, I don't think that's a bad thing. Why is it bad if a property sits for a month or two? Whereas, I think looking back at 2021, 2022, parts of or maybe not last year, if a property sat longer than a week, it was a big concern. So I like your idea of just, hey, like this is not doom and gloom with where transactions are at. And it's likely going to, all of these changes we're seeing will change that as well.
I certainly hope so. I mean, I didn't think that this market was something that was majorly concerning to me. In fact, I really quite welcomed everything just calming down and people calming down. Frenzy is just not a good thing. I am a big believer that just the frenzy around the financialization of the housing in the GTA has been a net negative, and we need more stable, predictable markets rather than this constant roller coaster. It feels like Toronto's just a light switch. There's no dimmer on that market, and to me, that's not a good thing. But I mean, look, this is the throes of what we're in right now, right? And the people who are making the decisions, sitting at a boardroom, around a table, pulling the levers are going to do what they're going to do. And we're just here along for the ride. And we have to stay on top of these things and we have to be able to educate people in a realistic sense and give them the context and the perspective of what does this actually mean for you today? How should you be viewing this today? Should you just go and blow your brains out with a mortgage because you can? Obviously, you shouldn't, right? But that's just what we think, right? There's other people that are going to have differing opinions. People should go out there and really listen to as many people as they can on that.
I'm with you. Yeah. Again, it's just there are options. So these are our opinions, and there are options to listen to other people and hear their opinions as well. Again, if you go online, you'll hear everything about this announcement. It's the best thing to ever happen to the mortgage landscape. And why would they ever do this? So there's two ends to everything. And kind of going along with what you said, like I don't deal with it as much when it comes to like, these seller mindsets on pricing or what buyers feel properties are worth. I'm more like what we're seeing, the I don't know what you want to call it, the ever changing rate mortgage rate environment is it's alarming for a lot of people. It's changing in the right way right now, but clients who got a mortgage a month ago with an amazing interest rate at that time are now coming being like, what the hell? Rates are so low right now. What's going on? Like, it's a very interesting time in real estate, in every aspect of real estate. And that's why I'm a believer that changes that were made today or that will become effective, that proposed today, in the long run, I do feel they will be beneficial for the sole reason of it's just another option for people who want to get into the market. It's another tool that we can use if it makes sense. But then really it's on the client and it's on the mortgage professional the client's working with to determine, does it make sense to do this? Like, does it make sense to pay over, let's call it a 5-year period? Does it make sense to pay an extra $26,000 of interest to the lender to get a property at 1.1 as opposed to 900,000? Like, what is, like, just does it make sense?
Yeah, I
I hope
that's
it's dumb
that's the
enough for
thing.
everyone.
I like that perspective. I like levers. I like options, right? That's always a good thing. But people need to go into these eyes wide open and understand what they're doing. And just because you're using a fork and a knife to eat your dinner, it doesn't mean you should take the knife and poke your eye out with it, right? Understand how to use the tools in front of you.
Yeah.
Really get educated on what you're doing. Don't blow your brains out just because you can. Make sure that you're talking to the right people. So this is this is the overarching message is everybody be careful out there, right? There's going to be a lot of shiny new objects that look really great, and you got to make these decisions more logically and less emotionally, and it's hard to do that with housing.
Oh yeah, that's what we see every single day. So yeah, I'm right there with you.
Well, I thank you so much for your time. As always, Jeff Mudrick, where can people find you?
You can go to chatwithjeff.ca. It'll give you right access to my calendar and just up the chat all things real estate. So anytime you want to hop on a call, you can go to chatwithjeff.ca and you'll find me there.
Awesome. Thank you so much, sir. Appreciate your time.
Thank you.
Konstantin Polyakov. How you doing, my man? Thank you so much on short notice for hopping on a Zoom. I wanted to chat about what's going on today because this is big news for the Canadian real estate scene.
Oh, yeah. Thank you for having me. Uh, I think this is an excellent idea to discuss just as the news are fresh out of the oven.
Yeah, so
Um,
explain to everybody what change has just occurred and how this is going to affect people.
so basically, what's happened is, and I think we talked about this maybe even on your podcast a little while back. If you remember, we were talking about what are some of the things that sort of the government and the industry can do to um, stimulate the real estate market because the real estate market has been going through a difficult time with the interest rates being as high as they are. And one of the things we talked about many moons ago was the Bank of Canada eventually lowering the interest rates. But the second thing that we talked about a little while back was regulatory changes, right? And we've seen some of those changes take place a little bit earlier when um, we finally seen 30-year amortization become available for new construction with down payments of less than 20%. We haven't seen it in a very long time, like 25-year amortizations for all insured products. But hey, now we have 30 starting August. And this is a second addition to that regulatory, how would I describe it, enhancement, I guess, or that little bit of fire, all right? And what it is them finally opening up to the idea of increasing insurability beyond the $1 million threshold. Because up until now, if you were buying with less than 20% down and you needed government insurance to qualify, well, you could only buy up to $1 million. Um, and then the sort of the scale, the down payment scale applies, right? Where the first 500,000, you need the 5% down payment, and then the 10% for the remainder of what you're applying for. So them coming
So,
out with a, yeah,
sorry to interrupt, just so we can explain this in like super, super simple terms to all everybody listening or watching on YouTube. Up to $1 million in Canada, you are allowed to put less than 20% down as the minimum being, I think it was 5%.
yeah, for anything under half a million.
For anything under half a million.
Yeah,
What do you mean? Sorry. Oh, was it scaled down to half a million for 5%? And then you
yeah.
you needed Okay, so explain to me what the brackets were.
So it was 5% for the initial 500,000. And then for any amount that's greater than 500,000 of your purchase price. So let's say take $1 million as an example, right? You were required to put 5% down for the first half a million and then 10% down for the remainder. So what's 5% of the first half million? It's $25,000. And what is the 10% of the remainder? Well, 10% of the remaining $500,000 on $1 million purchase is 50,000. So when you're buying a property worth $1 million using the traditional insured guidelines, $75,000 is what you actually need to be able to fulfill the minimum down payment requirement on $1 million purchase.
Right, so 7.5% up
Seven,
if you're right. So if you're buying at $999,000, you can put 7.5% down as a minimum. And anything over $1 million was a big jump because now you needed 20%. You could not purchase a property for $1 million and above with less than 20% down. And now
right.
they've raised that cap to $1.5 million. And this is, I think, what I wanted to talk about was what that actually means in terms of breaking down the numbers. Like, for example, if somebody had an amazing income, right? They're young, professional, they make great income, but they don't have that down payment. They were capped.
Yeah,
Now, what the government is telling us is they're no longer capped. If they have great income and they can qualify for a purchase above $1 million, but they don't have 20% down, they can still they can still make that purchase. And so how much buying power did people actually get now?
Well, the buying power, I think, still ultimately depends on what they make, but the range of what they can do with just the insured product, right? It's essentially now, well, 1.5 million as the threshold instead of the one. So what does that do to places like Toronto and Vancouver? Well, Toronto and Vancouver has been having serious problems with that exact segment of the market because the issue was that, well, if you are looking at the new generation of homeowners that are just entering the market, most of them just don't have the 200,000, 300,000, $400,000 down payment that you need to be able to buy stuff over $1 million. Maybe they had 50, 75, 100, right? It's just so hard to save up that much down payment. So unless they were upsizing from an existing property, it was just very hard to enter that space for over $1 million. Now, what that's going to do is going to actually stimulate that segment of the market. So whereas the million to million five was a segment of the market that may have been completely unattainable to the first time buyer, this is actually the first time in so many years where it is. It just becomes a matter of can you qualify, right? And so that what that's going to do is going to, in combination with the 30-year amortization becoming available for new construction projects, I think that in combination with this new change with the insurability now being available up to 1.5 million is definitely going to stimulate some activity. How much? I mean, we don't know, right? It's gonna take a little bit of time for it to materialize. But this is very, very important and very big news because this changes the way we, the mortgage brokers, can help customers. It changes the way you guys, the real estate professionals, can now make certain things available to these people where before they were not. And then ultimately, the people that are out there looking to buy things, looking to actually look at properties and uh, purchase their first home, well, now inventory that never used to be available is becoming available to them in their price range, and it's just a matter of doing the numbers and seeing if everybody qualifies.
I'm a little concerned, I will say that, when I first saw this, and I wanted to get your take on this. We've heard the conservative leader now, who seems to be more likely than not going to be our next prime minister, be extremely critical of CMHC, the Canadian Mortgage and Housing Corporation, who is giving out all of these, I mean, let's call it insurance policies on the amount between whatever they were putting down and leading up to the 20% mark for people who needed those insured mortgages for not having enough down payment. And this kind of reminded me, or was very reminiscent of 2008, right? Where we saw very little down payment, the incredible, just overarching encouragement of, people to take out debt, and more debt becomes destabilizing. How concerned are you about this policy shift in that regard?
I think it's going to be a game of cat and mouse, right? So we are still we still have quite a high risk of this backfiring, like you said, because we are extending things where maybe in the current environment where like the economy is not doing well and the market is not doing well, like it may be putting the insurer, the government into a position of risk. But then you also have to, I guess, think about what if they don't do this, right? Like, why are they doing this right now? Well, because they kind of have to. Things are not great. If we're talking about the real estate market itself, I don't have to tell you, you do this for a living. The number of transactions is so thin. And so what they're trying to do is they're trying to stimulate the number of transactions among the segment of the population that has been kind of not ignored, but has been sitting on a sideline, right? So yes, market is still suffering. Yes, there is still not a lot of transactions, but maybe it's doing initiatives like this where we are specifically focusing on the first time buyers, right? Where we're trying to focus on making homes available or making programs available to them so they can sort of enter the market and get their first home. I think that is maybe the right way to angle the problem, because if let's say we were to come out and say, well, why don't we just do this for everybody? Why don't we just do even 35 ERM or maybe a 40 ERM to help everybody qualify? Well, that's going to just push us back into the problem we had before the rate hike cycle started. We'll have a real estate market that's going to be overheating because availability of programs for everybody is going to bring everybody back to the market and is going to drive things out of control. But actually introducing programs that are just geared towards those first time buyers may be the way to normalize the problem.
I guess the concern that, Pierre Polyev really pointed out is, what if we go through this whole thing, we see another rate hike cycle again, right? Because inflation gets out of control, because we're essentially just rinsing and repeating,
Yeah.
right? And we've been down this road before. And what happens then if things get out of hand? We see the real estate market start to fray at the edges and eventually start to really tumble. And CMHC, based on their last audit, doesn't have the money to actually come up with, if, let's just say, all hell does break loose. So what happens then, right? I know I'm kind of talking about doom and gloom scenarios, but we've just seen such an explosion of debt. And it just seems, when I saw this, I immediately, alarm bells went off in my head. I was like, this is just more irresponsibility, right? That's at least what I was thinking. But I mean, you're the expert, so I wanted to have you on to, like, correct me if I'm wrong. Is it irresponsible, or are we gonna be fine?
If anybody really had a crystal ball to find the answer to that, we should probably be asking them. There is no way to find out without trying. The one thing I will say is that not doing anything right now would be probably worse. Uh, so they're starting to move the levers and change something hopefully with the hope that what they're doing is stimulating the right parts of the market, not all of it. And if, for example, their interest rates cycles, like you said, if the interest rate hike cycle restarts, because the inflation gets out of control, and CMHC is in a position where they now have to pay out all these defaults. Well, I think because even though the government isn't all that cohesive in its decisions, in its actions, I think it is ultimately cohesive enough in its actions and decisions to recognize that that is a problem, right? If the rate hike cycle starts to pick up again, recognize that that is a problem, recognize that CMHC is in big danger, and then put every possible make every possible decision they can to protect CMHC, whether that be by maybe loosening the regulations somehow else, right? To make sure that those insured mortgages don't all go defaulting. Because what happens, even if the rate hike cycle restarts and people are in their fixed mortgages, I mean, not a lot of them are going to, the ones that are in the fixed mortgage are not going to be really affected, right? The variable rate mortgages will get affected the most, or the renewals. So the rate hike cycle restarts, and the government sees that there's a big danger ahead, and the CMHC is about to be in real risk. I think that they will pull the levers and introduce changes that will prevent the catastrophe from happening. Because if they don't, well, then, like you said, we would be all in really big trouble.
So I guess the answer is, well, don't don't worry too much. We'll just print our way out of it. We'll paper over the losses like we normally do.
Unfortunately, that is the game, right? And so it's just a matter of, I guess, making sure we don't bury ourselves too deep.
Wow. Okay. Well, I mean, it is the answer I was expecting, so I'm not going to say I was totally surprised. But I mean, there you have it, folks. This is exactly what's happening right now. Is it going to throw gasoline, onto the small flame that we have right now for our market? Who knows? We'll see. But it's definitely good news for buyers if you were looking to purchase and you were kind of getting sick and tired of shopping for a shoebox of a condo. This is going to bump up some purchasing power if you've got good income. So thank you, Konstantin, for taking time out of your busy day. I know it's even, especially given the news, it's probably a busy one. So thank you very much for taking the time to join in. And yeah, everybody like and subscribe. Follow Konstantin. Konstantin, where can people find you?
Thanks, and I appreciate the opportunity. If you guys wanted to follow me, it's probably best to follow me on Instagram. That is the one platform I do use the most. You can find me at The Pocket Broker.
Awesome. Thanks again. See you, everybody.
Cheers.